Today we'll be talking about the 3 smart money moves that you need to make before the Fed lowers rates. And make sure you do this before everyone else. So just last month, the Fed Reserve decided to keep the interest rate the same, which means that they're holding at a 23-year high to keep inflation in check. But here's the thing, Jerome Powell, the Fed chairman, recently hinted that interest rates might be coming down soon because he states that we do not seek or welcome further cooling in the labor market conditions, and the time has come for policy to adjust. And this is big because Labor Department reported that unemployment rate is now at its highest rate in nearly 3 years, sitting at 4.3%. While inflation is still above the Fed's target rate of 2%, it has been steadily declining in the last few months. And this is a good sign that things might be turning around for the better. And to be honest, Jerome Powell has a tough job because no matter what he does, everyone's going to blame him on how the economy is doing, either for not raising or cutting interest rates quick enough. And remember, during the pandemic, the unemployment rate shot up to 14.8% in the spring of 2020, and the Fed responded by slashing interest rates to nearly 0% to stimulate the economy. And they kept rates low for about 2 years until unemployment dropped to 3.6% in March of 2022. But as a result, inflation went wild, peaking at 9.1% even after the Fed started raising rates again. Now we're on the other side where Powell is seeing the inflation finally coming down close to the target rate, but it's causing businesses to slow down their spendings and investments, leading to an uptick in unemployment. So economists and investors expect the first rate cut since 2020 to happen at the Fed's next meeting, which could happen as soon as mid-September. But don't expect anything drastic, as one financial analyst said interest rates took the elevator going up but are going to take the stairs coming down, which probably means just a quarter-point reduction from where it's at right now. But this gradual decline will affect everything from credit cards to auto loans and mortgages, making it easier and cheaper to borrow money. But the Fed has to be careful striking that perfect balance because they don't want the rates to get too high for too long, as that will unnecessarily slow the economy and the job market, which is happening right now. But they also shouldn't lower rates too quickly, as that might reignite the inflation that's just coming under control. So the first thing you should do before the Fed lowers rates is to lock in a high CD rate, which are the certificates of deposit. And if you're not familiar, a CD is a type of savings account that pays a fixed interest rate on the money that you've deposited for an agreed upon period. And the catch is that you can't withdraw the money without the penalty before the term ends. But the upside is that CD generally offers a higher interest rate than regular savings account. So as the Fed cuts rates, CD's rate will also come down. But if you already have an emergency fund of 6 to 9 months of expenses saved up, a CD will be a great and safe way to earn some extra interest right now. So today you could get around 5% interest rate for a 1-year CD. And if you're looking for something longer, expect around 4.5% return for a 3-year CD and around 4.3% for a 5-year CD. And you might see a trend that banks are offering lower interest rates on longer term CDs because they expect the Feds to cut rates in the future. And these CDs can be particularly attractive if you are close to retirement or need a fixed income because of their low risk and guaranteed returns. And just keep in mind, you might not want to lock in for too long, as you might miss out on other investment opportunities with higher returns, as CDs often again come with early withdrawal penalty. And the second smart money moves to make before the Fed cuts rates is to pay off your credit card debt. Because even if the Fed cuts rates a few times this year, a credit card interest rate is unlikely to drop fast enough and big enough to make a significant difference in your payments. And remember, when the Feds even held the interest rates to near 0% during the pandemic, the average credit card rate was still around 16%. Now it's hovering around 21%, with some rates nearing all-time high. So paying down your credit card balance will help you reduce your debt and also improve your credit score, which will be much more beneficial in the long run than waiting for the Feds to cut rates. And since most credit cards have a variable APR, your interest rate should adjust depending on what the Fed does, but that also doesn't mean the lenders will automatically lower your rates after the Fed's announcement. So your best bet is to pick up the phone and call your credit card issuers to see if they will negotiate a lower rate. And you might also consider transferring your balance to a card that offers 0% APR for a set period. And just to take a pause, if you are finding this content to be helpful, make sure you like this video and subscribe for more personal finance content. Now, the third smart money move to make before the Fed cuts rates is to consider buying a home very soon. That is, if you are financially ready. Because if you've been thinking about buying a home in the next year or two, now might be a good time to start house hunting. And as like most people, you might have paused your search because the mortgage rates were sky high, but the Fed's expected rate cuts could be your green light to jump back in. And if you are financially prepared to buy now, you could benefit from lower interest rates and improve inventory before the market really heats up. And as rates come down, more people will likely enter the housing market, leading to an increased competition and a potential bidding war. So it's worth noting that mortgage rates have already started to decline ahead of the Fed's predicted cuts. So being prepared to make an offer could give you an edge. Just make sure you're confident about the non-negotiables like location, neighborhoods, and any other big factors that are important to you. But the housing market is even starting to heat up around my area because a neighbor recently sold her house, I think around 3 bedrooms and 2 full bathrooms, and they listed it for just about $600,000. And within a week, after just one open house and a few private tours, it sold for $700,000, $100,000 over asking. And that's before the Feds even cut rates. So I can only imagine how competitive the market will get in the few months to a year if the Fed continues to lower rates for the remainder of the year. And as a bonus for watching this video, I created a home buyer's checklist that you could access for free down in the description below. And if you feel uncertain about your financial future or need a personalized guidance to make smarter financial choices, you can also check out my one-on-one coaching service to help you gain clarity and confidence with your money. And if this is your first time going through the process of buying a house, you can watch this video next where I talk about the 4 big mistakes that first-time home buyers make. So make sure you check that out next, and I'll see you guys there.